Friends, thank you for being here today. The intricate dance between central banking policy and the real world valuation of assets has rarely been more pronounced. In a move that has sent ripples across every financial market, the Federal Reserve has officially pivoted. This is not a subtle adjustment or a temporary technical correction. It is a profound policy shift that signals the end of one economic chapter and the jarring beginning of another. The central bank has initiated its second consecutive interest rate cut, an action that pulls the levers of the entire economy and forces us to ask a critical question, particularly for the average citizen. What does this mean for the roof over our heads? What does the Fed's new direction, a clear and deliberate move toward easier money, imply for the future of home prices? The answer is complex, but it is not ambiguous. The chain of events being set in motion, from the halls of the Federal Reserve to the open houses in our neighborhoods, suggests an outcome that runs directly counter to the narrative of an impending market crash. The story we are about to witness is not one of collapse, but one of inflation. Now, to kick things off, let's break down what the Federal Reserve is actually doing, because this policy shift with rate cuts and ending tightening is really ground zero for everything else. The most immediate and headline grabbing action is, of course, the rate cut itself. This decision by the Federal Open Market Committee, or FOMC, to lower its benchmark federal funds rate for the second time in a row is the explicit signal. A single rate cut can be dismissed as a mid cycle adjustment, a tap on the brakes or the accelerator. A second cut, however, is a statement. It is the confirmation of a new easing cycle, a period where the central bank will, in all likelihood, continue to lower borrowing costs in a series of steps. Market expectations, which are often a self fulfilling prophecy, are already pricing in further action. The consensus anticipates another cut of between 25 and 50 basis points, that is, one quarter to one half of 1%, as soon as the December meeting. But this explicit action, this lowering of the overnight lending rate, is arguably not even the most significant development. The real story, the one with multi trillion dollar implications, is the Fed's simultaneous signal that it is ending its program of quantitative tightening, often referred to as QT. To understand why this is so monumental, one must first understand its opposite, quantitative easing, or QE. During the crisis of 2008, and again during the pandemic of 2020, the Federal Reserve engaged in quantitative easing. This is the policy colloquially known as money printing. More accurately, it is a process where the Fed electronically creates new dollars and uses them to buy assets from the open market, primarily US Treasury bonds, and, crucially for the housing market, mortgage backed securities, MBS. This massive purchasing injects liquidity, cash into the financial system, spurs lending by banks, and directly suppresses long term interest rates, which is what made the 3% mortgage a reality. Quantitative tightening, or QT, is the precise opposite of this process. It is the Fed's attempt to undo that stimulus and shrink its balance sheet. Instead of actively buying assets, the Fed simply lets those assets mature as the government or homeowner pays back the principal, and then it destroys that money, not reinvesting it. This process effectively pulls money out of the economy. It is designed to slow things down, tighten financial conditions, and combat inflation. For the past year, this QT program has been running in the background, a silent but powerful headwind against the entire economy. Now, the Fed has signaled a pause, or perhaps a full stop, to that tightening program. This is the pivot. The cessation of QT is the first necessary step before the inevitable next one, a return to quantitative easing. By ending QT, the Fed is no longer removing liquidity. By cutting rates, it is signaling its intention to add stimulus. The combination of these actions is the clearest indication possible that the money printer, having been powered down for a brief and tumultuous period, is now being warmed up and prepared to be turned back on. So that leads to the obvious question: why is the Fed doing this? Why are they acting right now? A central bank with a dual mandate of maximum employment and price stability does not reverse course on such a massive scale without reason. The rationale for this pivot is twofold, revealing what the Fed sees as a clear and present danger to the economy. The primary driver is the weakening labor market. While inflation has dominated the headlines for 2 years, the Fed is now seeing alarming cracks in the other half of its mandate. The economy, according to their data, is slowing down much faster than anticipated. This is not just a gentle cooling, it's a rapid deceleration. Key indicators are flashing warning signs: a significant and sudden drop in small business hiring, a tangible rise in unemployment claims, and a noticeable increase in layoff announcements from major corporations. This situation is exacerbated by a government shutdown that has delayed the release of some official data. This has forced the Fed, by its own admission, to rely more heavily on alternative data streams. These alternative streams, real time payroll processing reports, private sector surveys, and high frequency data, are all overwhelmingly confirming that the labor market is softening and fast. The Fed is acting now because it fears over tightening and steering the economy into a deep and unnecessary recession. The second part of the rationale is the context of inflation. The Fed's aggressive actions in 2022 and 2023 were all designed to fight a 4 decade high in inflation. And while inflation still remains stubbornly above the Fed's official 2% target, it is, as one governor noted, not raging hot compared to the peaks of 9% seen in the recent past. This relative cooling, this downward trajectory, provides the Fed with the critical permission to act. It gives them the political and economic cover to shift their focus away from inflation, which they see as a problem being solved, and toward the new problem, the looming threat of a serious employment crisis. However, there is a third, more cynical or perhaps realistic interpretation of the Fed's actions. This view holds that the Fed is not just reacting to a weakening labor market, but is proactively preparing for an inevitable bailout. The financial system is choking on the highest interest rates in decades, and several sectors are on the brink of insolvency. The Fed's pivot is seen as a prelude to the moment when something significant needs to be bailed out. What are these potential triggers? The most obvious is the banking sector. Several regional banks are still struggling with massive unrealized losses on their balance sheets, and liquidity issues can flare up in an instant. The second, and perhaps the largest, is commercial real estate, or CRE. An estimated $1.5 trillion in CRE debt is coming due in the next 24 months, and these loans must be refinanced from rates of 3% or 4% to new rates of 8% or 9%. This is an impossible math problem for many building owners, and a wave of defaults is all but certain. A third trigger could be a severe stock market correction. A sudden 30% drop in the S&P 500 would vaporize household wealth and almost certainly force the Fed to intervene. In this light, the Fed's current rate cuts are not the main event. They are merely the preliminary step, the easing before the easing. They are the preparation for the moment when the Fed will be forced to unleash a new massive round of quantitative easing to save a critical part of the financial system. Okay, so that's the why. But what does this mean for your wallet, right? Let's talk about the immediate impact this is having on mortgage rates and all the activity we're seeing in the market. The Fed's actions are not just abstract economics, they have an immediate and direct impact on the cost of money for every American. We have already seen this in the mortgage market. After flirting with the psychologically devastating level of 8% in late 2023, the average 30-year fixed mortgage rate has already fallen, hovering now at around 6%. This is a direct consequence of the Fed's pivot. But how this happens is a subject of widespread public misunderstanding. It is a crucial distinction to make. The Federal Reserve does not directly control mortgage interest rates. This must be stated clearly. The Fed's rate cut applies to the federal funds rate, which is the overnight unsecured lending rate that banks charge each other. This rate directly influences short term debt like credit card APRs and auto loans. Mortgage rates, by contrast, are based on long term debt. A 30-year fixed mortgage is primarily correlated with the yield on the 10-year U.S. Treasury note. The 10-year Treasury is the benchmark for long term risk free debt, and mortgage lenders price their loans at a spread above this yield. So, what is the connection? Why did mortgage rates fall when the Fed pivoted? The answer lies in market expectations and the end of quantitative tightening. The 10-year Treasury yield is set by the bond market, by investors who are forecasting future growth, and most importantly, future inflation. The Fed's pivoted signal that it is more worried about a recession than inflation lowers the market's expectation for future growth. But the more powerful mechanism is the end of QT. By CEG, its program of selling bonds or letting them mature without reinvesting, the Fed is reducing the supply of bonds on the market. At the same time, by signaling a future return to QE, it is telling the market that it will soon become a massive buyer of those same bonds. Less supply and a giant new buyer on the horizon means the price of bonds goes up. And when a bond's price goes up, its yield, its interest rate goes down. This chain reaction, Fed pivots, is greater than QT ends, is greater than bond prices rise, is greater than 10-year Treasury yield falls, is greater than mortgage rates fall, is what has given the housing market a sudden, if temporary, breath of life. This new environment creates what many analysts are calling a window of opportunity. This period of falling rates, however brief, will have a clear impact. For prospective homebuyers who were sidelined by 8% rates, a 6% rate, while still high by historical standards, dramatically increases affordability and purchasing power. It brings buyers back into the market. For existing homeowners, this window is a beacon of hope. Anyone who purchased a home in the last 18 months or who holds a mortgage with a rate in the 6% to 8% range now sees a path to refinance. This is not an immediate opportunity, but it is a visible one. The crucial word in this forecast, however, is window. This opportunity is expected to be temporary. The very policies that are now lowering rates, the pivot, the end of QT, the future of QE, are by their very nature inflationary. Once this massive new liquidity injection, the money printing, begins in earnest. And once that money filters through the economy, it is expected to create a new second wave of inflation. And inflation is the mortal enemy of the bond market. When inflation reemerges, investors will demand a much higher yield on the 10-year treasury to compensate for the fact that their investment is being devalued by rising prices. At that point, the 10-year yield is expected to shoot back up, taking mortgage rates right along with it. This window of opportunity will slam shut, and rates could be even higher than they were before. But that's just the immediate stuff. What's really critical is the long term forecast, especially what this all means for asset inflation and, you guessed it, home prices. This leads us to the long term forecast, the ultimate consequence of the Fed's new policy direction. The core thesis is this: the large scale injection of new money into the economy, which is the definition of quantitative easing, will lead directly to large scale asset inflation. When the Federal Reserve prints trillions of new dollars, those dollars must go somewhere. They do not distribute evenly. They flow into the financial system, driving up the prices of all scarce assets. We will see it in the stock market. We will see it in the price of gold and other commodities. And most profoundly, we will see it in real estate. This is the most critical point for anyone waiting for a housing market crash. The very policies being enacted to prevent a financial crisis will, as a direct consequence, make a housing price crash all but impossible. Instead, the forecast is for the opposite: a significant rise in home prices, one that could even be described as skyrocketing. Housing in this new paradigm will not be immune to the widespread inflation caused by this massive monetary expansion. In fact, it will be one of the primary beneficiaries. Real estate is the quintessential hard asset. It is a tangible, scarce, and necessary good. In an environment where the currency itself, the US dollar, is being systematically devalued by the creation of new units, the price of that hard asset must rise in dollar terms. This fundamentally reframes the purpose of home ownership for the coming decade. The primary rationale for buying a home may shift. It becomes less about a short term investment and more about a long term strategy for asset protection. Owning a home becomes a way to shield one's wealth from the corrosive effects of currency devaluation. It is a lifeboat in an inflationary storm. But this new reality has a dark and deeply problematic side: a worsening affordability crisis. The very asset inflation that protects current homeowners creates an insurmountable barrier for new entrants. The fundamental problem is that wages do not and cannot keep pace with asset inflation. Incomes may rise by 3% or 4%, but when the assets they wish to buy are inflating at 10% or 15% per year, the gap between the haves and the have nots widens into a chasm. The situation is predicted to get unequivocally worse for affordability. This trend creates a market dynamic that heavily favors cash buyers and large scale institutional investors. The BlackRocks and Vanguards of the world, pension funds, and private equity groups are awash in capital. They can and will purchase homes and entire neighborhoods with cash, completely bypassing the high interest rate mortgage market that locks out the average family. This leads directly to the new landlord scenario, where the dream of ownership is replaced by the reality of permanent rentership for a growing percentage of the population. The home becomes an asset class on a balance sheet, not a cornerstone of a community. Let's really double click on that because this isn't just a minor side effect, it's a profound structural transformation of our society. This shift creates a permanent renter by necessity class. Think about what that means. The classic American dream was built on the idea that you work hard, save money, and buy a home. That home was your primary vehicle for building intergenerational wealth. But in the scenario we're describing, that path is being systematically shut down. The new reality becomes you work hard, save money, and watch as the price of entry, the down payment, inflates faster than your savings ever could. You are perpetually on a treadmill, running faster just to stay in the same place, while the asset owners are on an escalator, rising effortlessly. This economic bifurcation is frankly the most significant domestic consequence of this monetary policy. It creates a two-tiered economy, those who own assets and those who earn wages. The wage earners, even high income earners like doctors and lawyers, find themselves struggling to compete with the all cash offers from institutional funds that are funded by globally sourced capital. The asset owners, by contrast, see their net worth explode simply by holding on. This isn't capitalism as it was traditionally understood, it's a form of financial feudalism, where ownership of productive assets is concentrated in fewer and fewer hands. What's worse is how this new dynamic changes the market mechanics. In previous cycles, a recession would cause home prices to dip. It was a painful but necessary correction that would bring prices back in line with local incomes, allowing a new generation of buyers to finally get their foot in the door. Now, with these massive institutional players in the market, they create a buy the dip floor. When prices begin to soften, they don't see a crisis, they see a sale. They deploy their trillions in cash and buy up the inventory, preventing the market from ever truly correcting. The crash that wage earners are hoping for to make housing affordable never arrives. This has a powerful psychological effect. It breeds resentment, cynicism, and a sense of hopelessness. It creates enormous political pressure as the renter by necessity class grows larger and more vocal. They are trapped, paying ever increasing rents to the very same entities that outbid them for the home they wanted to buy. This is an inherently unstable social dynamic, and it's a direct result of a policy that prioritizes asset price stability over genuine market based price discovery and affordability. This is the long term, painful social cost of the Fed's decision to keep printing money. Now, I know what a lot of people are thinking when they hear this: a rise in prices. This sounds like a bubble. They're expecting a 2008 style crash. But it's critical to understand why this is not and cannot be a repeat of 2008. To the average observer, this forecast may seem impossible. For an entire generation, the concept of a housing crisis is synonymous with one event: the global financial crisis of 2000. The expectation is that all booms must be followed by a 2008 style bust. This comparison, however, is fundamentally flawed. The current market is not the market of 2007. The underlying structure, the financial health of the borrowers, and the supply demand dynamics are not just different, they are the complete opposite. The first and most glaring difference is homeowner equity. Today, American homeowners are collectively sitting on trillions of dollars in equity. The rapid price appreciation of the past decade means the vast majority of owners have a massive financial cushion. In 2007, the market was characterized by jingle mail, a cynical term for the phenomenon of homeowners who had 0% down loans and thus zero equity, simply mailing their keys to the bank and walking away when they found themselves underwater, owing more on the mortgage than the home was worth. Today's equity rich homeowner will not walk away. They will fight to protect the single largest source of their net worth. The second and most important difference is the quality of the borrower and the lending standards they met. The crisis of 2008 was not just a housing crisis, it was a subprime mortgage crisis. The lending standards of that era were, in hindsight, criminally negligent. In 2007, the average credit score for a mortgage was a mediocre 689B. Debt to income ratios, or DTIs, of 50% or even 60% were commonplace. The market was built on a house of cards, 0% down loans, no doc loans, where the borrower didn't even have to prove their income, and adjustable rate mortgages, arms with balloon payments that were designed to explode. Compare that to today. The average mortgage borrower has a FICO score of 736. The average debt to income ratio is a conservative 36% to 38%. The 0% down loan is gone, replaced by standard down payments of 3% to 20%, with nearly 30% of all buyers paying in all cash. The vast majority of homeowners are locked into stable 30-year fixed rate mortgages. The borrower of 2007 was a ticking time bomb. The borrower of today is a fortress of financial stability. The third critical difference is housing supply. The crash of 2008 was precipitated by a massive glut of inventory. In the mid 2000s, home builders were on a speculative frenzy, building far more single family homes than the market could possibly absorb. When the music stopped, the market was flooded with unsold properties. Today, we have the precise opposite problem, a chronic structural shortage of single family homes. For a decade following the crash, home building ground to a halt and never fully recovered. We are, by most estimates, millions of homes short of what the population needs. It is worth noting that there is an overbuilding glut in one specific sector, is large multifamily apartment complexes, which is creating good deals for renters in some cities. But for single family homes, the object of desire for most American families, the inventory remains desperately tight. Finally, there is the foreclosure situation. While it is true that foreclosure activity is ticking up from its historic pandemic era lows, these numbers are not a systemic crash trigger. They are a blip, a return to a normal pre pandemic level. They are nowhere close to the tidal wave of foreclosures we saw in 2005, let alone the peak in 2008. The current slight rise in foreclosures is not a sign of systemic collapse. Instead, as we will explore, it is a small scale opportunity for savvy investors in a market defined by scarcity. So, if it's not a 2008 crash, what is this market? Let's pull it all together by looking at the current landscape and, most importantly, what the strategic opportunities are for you. Understanding these powerful countercurrents, the inflationary force of Fed policy versus the regional realities of the market, is key to identifying real strategy. The national home price picture is not a monolith, it is a market of two tails. While the national average home price is indeed at or near its all time high, up approximately 1.7% year over year, this average masks a deep regional divide. In some metro areas, particularly those that saw the most absurd speculation during the pandemic, prices are falling. Markets in the South, like parts of Florida, and on the West Coast, are experiencing tangible price declines and a correction. Simultaneously, the heaviest concentration of price growth is now found in the more affordable and stable markets of the Midwest and the Northeast. This is not a single national bubble, it is a complex and shifting patchwork of regional markets. This landscape, combined with the Fed's new policy, creates three distinct strategic opportunities for individuals and investors. The first is the refinance play. This is a strategy of patience. For the 30% or 40% of homeowners lucky enough to be sitting on a mortgage rate of 3% or 4%, the strategy is simple: do nothing. That loan is a valuable asset that should never be given up. But for the millions who bought or refinanced at 6%, 7%, or 8%, the strategy is to prepare. This window of opportunity created by the Fed's pivot may allow them to refinance to a lower rate, potentially saving hundreds or even thousands of dollars per month. The second is the acquisition play. This strategy is based on the crucial distinction that this is not a distressed market, but it is a market that contains distressed sellers. These sellers are not a systemic threat, but they are a personal opportunity. They can be found in two primary places. First is the slight uptick in foreclosures, which allows traditional investors to acquire properties at a discount. The second, more nuanced opportunity is targeting the flippers. During the boom, many speculative investors used high interest, hard money loans to buy properties, intending to fix and flip them quickly. Now, with the market slowing and their properties sitting unsold for 100 days or more, these flippers are trapped. The high interest on their loan is eating away at their potential profit every single day. They are highly motivated sellers, and a lowball cash offer may be the lifeline they need to escape, providing a significant deal for the buyer. The third and final strategy is the landlord divided by rental strategy. This directly aligns with the long term theme of asset protection. Acquiring rental properties, whether through targeting foreclosures or distressed flippers, perhaps using business funding rather than personal loans, is a key strategy for the inflationary environment ahead. Owning rental assets allows an investor to benefit from inflation rather than be victimized by it. When property taxes rise, they are passed on to the tenant. When maintenance costs rise, rents are adjusted. The rental property becomes a direct hedge, generating cash flow while its underlying value appreciates in step with the very inflation that is eroding the savings of others. In conclusion, the Federal Reserve's rate cut is not a simple adjustment. It is a watershed moment. It signals the end of a brief, painful experiment with monetary tightening and the beginning of a return to the inflationary policies of the past decade. The pervasive fear of a 2008 style crash is misplaced. It is a ghost story that ignores the fundamental realities of today's market: massive homeowner equity, rock solid borrower qualifications, and a chronic undersupply of homes. The true threat is not a crash, but the opposite: a relentless, policy driven rise in asset prices that locks out an entire generation. The implications for home prices are clear. They will not be immune to this new wave of monetary expansion. They will be one of its primary expressions. In this new era, real estate is not just shelter, it is a hard asset, a store of value, and one of the last reliable shields against the slow and silent erosion of currency devaluation.